a thesis that I've had for now more than a decade about how the flywheel can accelerate over time. If we look at the monetary economics of currency adoption, one of the mechanisms is through what Paul Krugman disparagingly called a speculative attack. I think that it really is a virtuous cycle that is good for civilization. It's really about creating value, not only for the individuals that hold Bitcoin, but also for all of the individuals who, in one way or another, have Bitcoin exposure. Welcome to the Bitcoin for Corporations show. My name is Pierre Rochard. I'll be your host. And on this first episode, we're going to walk through Bitcoin, why it matters for corporations, why it's getting adoption, and how. And before we go through that overview, I want to introduce our producer, Spencer from Bitcoin Magazine. Hey, Spencer, how are you?
Thank you, Pierre. Appreciate it. Really excited to be launching this show with you. I think that there's really never been a more auspicious time to be exploring the intersection of corporate finance and Bitcoin, especially on the heels of last week's Strategy World Bitcoin for Corporations event. But also in terms of the macro backdrop that we see ourselves in right now, whether that's inflation expectations or the treasury market, there's just so much to parse. And I think that institutional and corporate players are really waking up to the fact that Bitcoin is a unique asset that is also here to stay. So looking forward to exploring that with you. And for the viewers, I'll be here lurking in the background, adding context as necessary. But for the most part, we'll have the master of ceremonies here, Pierre, to take it away.
Awesome. So, this show is really geared towards CFOs, financial professionals, treasurers, as well at large publicly traded corporations, medium-sized ones, small ones, as well as family offices and privately owned businesses who really want to understand the financial side of Bitcoin on top of the fundamentals of the Bitcoin system itself. So, just by way of introduction, I'm Pierre Rochard. I'm the CEO of the Bitcoin Bond Company, a company I founded earlier this year on the heels of 10 plus years in the Bitcoin industry. So, I co founded the Satoshi Nakamoto Institute. I've worked in public accounting at Deloitte, as well as a number of different roles within the ecosystem. So, I was at BitPay, a Bitcoin payment processor, Hudson River Trading, a high frequency trading shop, Kraken, a large exchange, and most recently, Riot, a large publicly traded Bitcoin miner. So I've had a lot of experience in all the different parts of the Bitcoin ecosystem. I've learned a lot along the way. So I'm excited to share that with our audience. And I've also contributed some open source code here and there. So I'm familiar with the underlying software engineering as well as the financial engineering that goes on top of Bitcoin and that we're seeing develop in real time. And so it's exciting to be on this journey with you. And if you ever have any questions or comments, feel free to send them in. We'll certainly want to address those in future episodes. We'll have guests going forward. So if you have any guests in particular that you would like for us to speak with, feel free to submit their names and we'll be happy to bring them in for a conversation. So, zooming out, the big challenge for corporate CFOs today is this balance between the return on invested capital on the asset side of the balance sheet and then their cost of capital on the liabilities and equity side of their balance sheet. And in good times, you have a return on invested capital that is greater than your cost of capital. But we've seen over the past decade, it has gotten increasingly challenging. So, as we start diving into why Bitcoin matters for corporations, we have to start from first principles about the challenge facing CFOs today, whether it's for a public company or a private company. It's finding that spread between the return on invested capital of the assets of the corporation and the cost of capital, whether it's in the form of debt or equity. And it has become increasingly challenging to find those opportunities to create that spread. If we look at the return on invested capital, uh, Over the past decade, that has been compressing and eroding for a number of different reasons. One is the globalization of competition. So, international trade means that goods and services can be produced anywhere in the world, and that every company has to be competing in that environment. On top of that, there's been a tremendous rise in inflation for the input costs of corporations. So, that can take the form of wages, but also of commodities, intermediate goods, that has really accelerated with the post COVID monetary expansion. Third is the network effects of big tech, the Magnificent Seven. They've really developed moats around their products that allow them to have quasi monopolies in a lot of different verticals. And so, for corporations that are trying to compete in the digital age, they can quickly find themselves to be obsolete or squeezed out by uh, other companies, especially when we look at, for example, e commerce with the giants like Amazon that are able to leverage their position to drive down the profit margins of their competitors or even of the participants in their ecosystem. As Jeff Bezos put it, your margin is my opportunity. Furthermore, on the innovation, it is accelerating. And if we look at the trends in AI, it's becoming harder and harder for small and medium sized businesses to keep up with the changes that are happening. And even large companies are having a trouble pivoting and finding new strategies to adapt to the technological environment, where we could even see AI driving down costs, and that could be an opportunity, but it's also a huge challenge, especially when there's a shortage of talent that understands AI and how to harness its possibilities. And then, of course, there's the regulatory uncertainty with every new administration here in the United States, but even globally it comes with a bit of whiplash of changing policies, whether it's related to trade or immigration or to taxes and spending. So navigating those is increasingly challenging. And last but not least, when a corporate is holding cash, we've seen a lot of environments where the cash is actually having a negative return, even if it's invested in money market funds or other short term duration bonds. The returns from those are just not keeping up with the purchasing power of the dollar or whatever the local currency is of the corporation. So that presents a huge challenge on creating the returns on assets to be able to create value for shareholders. And then on the other side, on the cost of capital, we've also seen that increasing at the same time. So the Federal Reserve, in response to the increase in consumer price inflation, has been hiking interest rates over the past couple of years. And so now we're in an environment where debt is getting more and more expensive for corporates, and equity markets are increasingly demanding from management really superior performance to invest in them. And so we're seeing equity markets really concentrate on those magnificent seven, and that takes capital, equity capital, away from everybody else in the market and makes it more expensive for them to access that capital. This is where we get to Bitcoin. Bitcoin presents a really a diametric opposite picture, where if we look at the past 10 years for Bitcoin, it's really been the best performing macro asset. And if we look at the market cap of Bitcoin, it grew from almost $0 to now north of $2 trillion. It's not just that Bitcoin's a store of value, right? Bitcoin's not just digital gold. It also has tremendous transactional utility. And if we look at the growth of the transaction volume on the network, quarter over quarter, it's now at $5.5 trillion turnover in terms of the amount of value that is being transacted on the Bitcoin network. The direction of the growth, I think, also shows that there's fundamental adoption for Bitcoin, not just as a store of value, but also benefiting from its 24/7 global digital nature. What is this backed by? So, Bitcoin's monetary policy is backed by open source code. Bitcoin is the most transparent monetary system in the history of humanity. Anybody can contribute to this code, but ultimately, to make that contribution concrete, you would have to see people adopt it in the node software. And so, this is key to Bitcoin's decentralization. So, this really shows that Bitcoin, it's fundamentally it's an accounting system. It's a decentralized accounting system. It's the first decentralized accounting system, and I would argue the only, because it doesn't have any single points of failure. And that is downstream of a software development process that is very conservative and focused on the security and the stability of the system above all else. So, Bitcoin might not have all the features and smart contracts of other platforms, but what it has is an unparalleled level of reliability, which is critical for a monetary system that is being adopted not only by individuals, but also by corporates and governments. As Larry Fink put it, Bitcoin's an international ledger that is cross border. It's bigger than any government. So when we think about the Bitcoin monetary system, it does not belong to China. It does not belong to the United States. Uh, it doesn't belong to Russia, right? This is a monetary system that is neutral. It exists in cyberspace on the internet. So, as Jack Dorsey put it, it is the native currency of the internet, and that has grown and that has contributed to its adoption. So, that's a way to think about Bitcoin as a monetary system that combines the scarcity or even greater scarcity than gold with the digital 21st century technology of the internet.
Yeah, and Pierre, just to kind of bring it back to what you said at the beginning, I think that in the context of the Federal Reserve, and essentially you have this political system that is the governance mechanism in comparison to Bitcoin's code based open source governance mechanism. Just today, we have President Trump saying that he wants Powell to lower interest rates. And so you kind of have this uh, relative instability of the governance of the US Treasury market as well as the US dollar. And then on the flip side of that, you have the relative instability of corporate competition, whether that's incumbents being disrupted or you have essentially these moats that are also being kind of fed by kind of monopolistic regulation through things like lobbying. And so I think between those two, each that rock and a hard place, you have Bitcoin that exists as this middle way out for folks looking to protect their balance sheets and grow their capital simultaneously. And I know we'll get into that as far as the opportunity, but I think right now that connection has never been clearer, and really that contrast between these different types of assets.
Completely agree, Spencer. That's a really good point to highlight. Is the Because we often hear about Bitcoin's volatility on its price side, we really have to ground that in the stability of the underlying system and its resistance to outside pressures. We've seen, for example, situations where people might think that there should be a bailout and that we need to print more Bitcoin, and because of the decentralized nature of the system, that's impossible. And so Bitcoin doesn't have bailouts. It really comes down to the responsibility of the users on top of it to make good use of it. So when we look at Bitcoin's financial performance, we can look at the lens of, okay, Bitcoin went from $0 in 2009 to one Bitcoin being worth north of $100,000 today as we record. And so, if we break that into a 6 year compounded annual growth rate, a CAGR, we see that Bitcoin has been growing within any 6 year time horizon a rate that really exceeds any other kind of asset out there. And so, as we record today, if you had bought Bitcoin 6 years ago, you would have had a 55% annualized compounded annual growth. And so, this is really a, a, what sets Bitcoin apart from other assets and establishes a framework for from a financial performance perspective of why you would want this asset to be on your balance sheet, why it would, when you think about your return on invested capital, contribute positively to that return. And that while, yes, in the short term, Bitcoin is volatile, in the longer term, there is fundamental adoption happening. And that's why that growth rate has been sustained over time. So going forward, uh, we'll see what happens. Obviously, past performance is not necessarily indicative of future performance, but it's really important to look at the past performance so that we don't have a one-sided view of Bitcoin's volatility, because we have to keep in mind that the volatility has really been skewed positively, and that if we look at past bear markets, they only occurred because Bitcoin increased in value too quickly, is what I would argue. And that going forward, we'll see Bitcoin continue to grow, and we'll see Bitcoin's price oscillate around that growth rate, but that it's going to be outperforming other assets.
Yeah, yeah, and I think that you have the ability to look forward and say, given the historical returns and what we might project forward based upon those, you have an idea of what a different distribution of those returns may look like. And so you can essentially structure different financial products using Bitcoin as collateral, Bitcoin to improve credit worthiness, where you can take into account, okay, if we see the 1 percentile of returns relative to historical performance, how do we structure a product that takes that into account? And so it's not just number go up over time, but it's how can we use this unique financial performance to create distinct types of financial engineering that actually essentially is a new form of niche construction for risk managers.
That's right, and the risk management is key here because with the volatility, you can misuse Bitcoin as an asset and end up having to uh, panic sell at the bottom, and so it's very important to be keeping in mind that Bitcoin has had severe drawdowns in the past, and that if you want to build a fortress balance sheet, you have to be using the right tools to do that. Now, corporations also have to keep in mind that when it comes to adoption, they are not the only players. And so we continue to see adoption from individuals. We saw earlier this year, President Trump signed an executive order to establish a strategic Bitcoin reserve, which, first of all, will stop the federal government from selling Bitcoin. And second of all, has instructed the cabinet to identify ways to continue to accumulate Bitcoin in a budget neutral manner. And so the government will be competing with individuals and corporations to acquire Bitcoin. And at the state level, we're also seeing a lot of progress on the ratification of strategic Bitcoin reserves for those states to be accumulating Bitcoin as well. And that's just in the United States. Globally, we're seeing more and more interest from sovereign wealth funds, for example, that are adding Bitcoin as an asset to their portfolios, first as a diversification, as a hedge, but also as a way of establishing their own sovereignty and independence from other payment systems so that they have the freedom to transact regardless of geopolitical developments going forward. And so corporations are in a position where there's a tremendous first mover advantage, and we'll get into that. I want to point out that even with this tremendous amount of growth for Bitcoin, where now it is north of a $2 trillion market cap, that pales in comparison to the size of other assets. Gold, for example, is $16 trillion. So let's round that up to 20 trillion, and let's be bullish for gold here for a minute. Um, that means that if Bitcoin were to grow to gold's market cap, that's a 10x from here. So that would put Bitcoin at $1 million per Bitcoin. Art as well is around $20 trillion. Cars and collectibles, $6 trillion. Equities, $115 trillion. Real estate, $330 trillion. I think real estate's a really interesting comparable for Bitcoin, because when we look at a metaphor, for example, would be that the 21 million Bitcoin or the 19.9 million that have been mined, and even fewer than that that are really available on the market because some of the Bitcoin have been lost. If we rewind back to 2009, Bitcoin had a market value of $0. And some people were mining a lot of Bitcoin and did not see it as particularly valuable. So they might have accidentally deleted the private keys or thrown it into a landfill. So there's a lot of lost Bitcoin as well, where today I've seen estimates that really there's only 15 million Bitcoin. And so if you think about those 15 million Bitcoin, you could think of them as plots of land on the island of Manhattan, right? This is scarce real estate that is being competed for and that is being developed on, that is in dollar terms, in today's value, much smaller than the global real estate market. But as people learn and as corporations and governments come to understand the fundamentals that we've gone over today, it will click for them that this is scarce real estate and that Bitcoin's going to has a path to grow by orders of magnitude from where it is today. So if Bitcoin were to really get onto the same size as the global real estate market, that means you would be looking at Bitcoin at $30 million per Bitcoin.
I guess I would just add that it is incredibly scarce, but the people who own it already are increasingly those who understand and appreciate that scarcity. And we have the launch of the Bitcoin ETFs that I think reflect that very nicely, where you essentially have the most well capitalized segment of American society, in that it is people who are investing passively into ETFs or BlackRock's own funds that are purchasing these Bitcoin ETFs. And these are the folks I think that are, as we say, diamond hands in the industry. But I think that yes, it is incredibly scarce, but the demand has, in many instances, already absorbed so much of the outstanding supply, and I think that that also really highlights both the time sensitive nature of corporations understanding the importance of Bitcoin. And also, I think justifies what you just mentioned as essentially a $30 million per Bitcoin price target in the longer term. Like those two things together, I think really highlight the urgency of the situation.
Yeah, absolutely. And Spencer, that reminds me of a metaphor that I like a lot, which is that Bitcoin's not a Ponzi scheme; it's a relay race. And so you have people who held Bitcoin from they might have mined it or bought it at $1 or $10 per Bitcoin, and when it hit $100,000, that was a life changing opportunity for them in terms of maybe rebalancing their portfolio, and paying off their mortgage and putting their kids and nieces and nephews through college and starting their own business or whatever it is. Um, that then they hand that baton off to, let's say, IBIT's BlackRock ETF. Um, it- so somebody buying Bitcoin today at $100,000, we could ask ourselves, well, at what price would they be willing to hand it off to the next buyer? And I think that you're right. It shows that the grip strength on that is going to be much greater, because they now have 16 years of Bitcoin history, right, from 2009 to today. They can see the trajectory that Bitcoin's on. Bitcoin, in many ways, has been de-risked. When the early adopters were getting into Bitcoin, one of the big questions was, is the government going to ban Bitcoin? Now the question is, how much Bitcoin is the government going to acquire? And so we're in a completely different environment, which I think is going to shape how people view Bitcoin, more as intergenerational wealth, rather than any kind of get rich quick scheme. The bond market is $300 trillion. And so when we look at that fixed income market and we compare its real after inflation risk adjusted yields, they are far lower than Bitcoin's long term CAGR. And when we look at the bond market, we have to keep in mind bonds are all about long term returns, right? So if you're buying a treasury that's a 5 year, a 10 year, a 30-year treasury, you're expressing a view on a very long time frame. And while Bitcoin is still young, it's only 16 years old. When we look at the fundamental software architecture of the system, it is built to last. And I think that it will last centuries and millennia and indefinitely, really. There's not a lifespan to Bitcoin, which makes it uh, very, I think, in the longer term, very competitive with bonds. And in the shorter term, we have to think about, well, what are credit instruments that could be built on top of Bitcoin that provide that downside protection to traditional bond investors while still giving them opportunities in terms of Bitcoin's upside volatility skew. So we'll be looking at some of those instruments in a minute. And of course, money. So when we think about M1 and M2, yes, the dollar is arguably the least worst government currency. There's lots of other currencies out there, like the Turkish lira, that have underperformed the dollar, and so we might see that there's increased adoption of Bitcoin, not just as a monetary digital gold, but also as a transactional currency that just works better than local alternatives. Okay, so it's really interesting to look at the trends lately in terms of corporate adoption. That it has been leading the way this cycle. In past cycles, Bitcoin has been heavily retail driven. This cycle, looking at 2025, thanks to our friends at River, River.com is a great Bitcoin only brokerage to for small and individuals and even medium sized businesses to go acquire Bitcoin. They have looked at where the buyers have been this cycle, and it has been dominated by businesses. And individuals have really been net sellers in this environment. And then, of course, in between, funds, ETFs, and governments have also been buyers. Another player in this space, Bitwise, they have a ETF, a Bitcoin ETF, and other institutional grade products. They've been looking at the growth in Bitcoin corporate holdings versus how much Bitcoin have been mined. And so in 2025, 60,000 Bitcoin have been mined. So that means that through Bitcoin's decentralized issuance process, those Bitcoin have been added to the ledger, getting us to 19.5 million Bitcoin. Um, but the growth in Bitcoin corporate holdings has been triple that. So 196,000 Bitcoin have been acquired by corporates in 2025, which really presents an interesting picture. If we just think about Bitcoin from economics 101, supply and demand, the demand is just far greater than the supply. When we break it down by different corporations, here we have a leaderboard essentially of publicly traded uh, U.S. corporations and what their treasury has grown to. The leader by far is Michael Saylor's strategy, previously known as MicroStrategy. Um, Second up is, and really, there's actually four Bitcoin miners that are runner ups here. So Strategy has $52 billion worth of Bitcoin as of May 29th, or sorry, April 29th. That number I know has increased with every press release from Mr. Saylor. He is not relenting on his strategy. And then you've got Marathon, Riot, CleanSpark, Hut 8 that all have from $4 billion to $1 billion worth of Bitcoin on their balance sheets. We have Coinbase. Coinbase recently got added to the S&P 500, so congratulations to them. Hopefully, that will give them greater access to capital to work their way up the leaderboard here. Currently, they are just shy of 10,000 Bitcoin. There's Block, which you might also know as Square. It's led by Jack Dorsey. And then others that form a long tail of Bitcoin holders. So, what are some of the different reasons why corporations need Bitcoin beyond just increasing uh, the quality of the balance sheet, increasing the return on invested capital? We also have to think about it from a strategic perspective that having a very liquid asset on the balance sheet that is a commodity, right? So that's an important aspect of Bitcoin from a regulatory perspective is that a publicly traded company can acquire a large holding of Bitcoin on their balance sheet without triggering concerns about holding securities and becoming an investment company. As long as they're accumulating Bitcoin as a commodity, they can develop a very large reserve, which gives them a lot of flexibility going forward for future investment opportunities. It also provides form of permanent capital that gives certainty to customers and employees that this corporation is here to stay. That even if there are short term challenges for perhaps the operating business or anything like that, that they have the reserves to weather that. And of course, that Bitcoin outperforms other liquid assets that a corporation might deploy as part of its treasury strategy. So if we look at short term bonds or money market funds, as we mentioned, those have underperformed Bitcoin over long time frames. Now, we've also seen evolutions in how corporates execute their Bitcoin strategy. I think that at first it really started as a treasury diversification play where they might allocate a small position of, let's say, 5 to 10%. We could point to players like Tesla, for example, that did this. And then we saw that they would grow their allocation to really become a treasury reserve strategy. And we saw Michael Saylor do this, where eventually it becomes 50 to 90% of the position. And the latest evolution has really been to lean into the financial engineering of Bitcoin. That is, that on top of its growth rate, that the volatility actually, rather than being a liability or a hindrance for Bitcoin adoption on the corporate balance sheet, that it could actually be harnessed positively with financial engineering and develop instruments on top of it that allow for having a position that's greater than 100% with intelligent leverage, as Michael Saylor puts it. So let's zoom in on that. This chart from Strategy's slide deck shows the different products from a capital markets and capital structure perspective that they've developed on top of their Bitcoin treasury strategy. So they have issued preferred stock in the form of Strife and Strike, which is essentially de-risking Bitcoin exposure for the holders of it. And so deleveraging the position so that it starts to look more like a high octane fixed income instrument that allows MicroStrategy to then leverage up MSTR as the leveraged Bitcoin equity. And then if we go look out on the curve here, they've also been very active in the issuance of convertible bonds, where they can look at the volatility of Bitcoin layered on top of that, the volatility of MSTR as a leveraged Bitcoin instrument, and to then be able to sell that volatility in the form of convertible bonds where rather than paying cash interest to borrow dollars, they're able to monetize the volatility with that embedded call option in the convertible. And so we'll be in future episodes really zooming in on how that works and what the challenges are, what the opportunities are for different financial instruments that go further in the direction of financial engineering for corporations that are developing a Bitcoin strategy. We've also seen a huge uh, increase in the options volume for MSTR. And so here on the right, you see the volume of call options and put options on MSTR, where it really shows that yes, Bitcoin can be volatile, but that volatility can be transformed into an asset when we look at the fact that options traders, market makers, are very interested in developing strategies that use the volatility to their benefit. So it's not just that volatility is bad. We have to think about volatility as part of an overall financial engineering toolkit. And this chart looks at one of the metrics, and we'll be digging into other metrics as well when it comes to uh, corporate adoption of Bitcoin. But one that the market has been looking at is called MNAV. So looking at, okay, what is the value of the Bitcoin on the balance sheet? And then what is the value of the common stock? And developing a multiple around that, where we see lately that has been around 2x. It has certainly evolved over time. So we've seen it go up, we've seen it go down. Um, but thinking about what drives that MNAV, because if we think about the Bitcoin ETF or ETPs, typically they would have an NAV of 1x. That is that for every one Bitcoin that's in the vehicle, there's one Bitcoin's worth of equity. But as companies develop their Bitcoin strategy, we're seeing that there's the opportunity for multiple expansion based on the fact that there's demand for the common stock, driven by not only current leverage but also future leverage, whether that's in the form uh, of preferred stock or of convertible bonds or of the options markets that are driving demand for the underlying equity. And this is what allows then for the corporate issuer of the common stock to be able to sell the common stock, issue more of it with ATM offerings and other ways that allow them to essentially be able to buy Bitcoin and as sailors put it, to sell $2 worth of stock to buy Bitcoin um, for $1, and that allows them to generate that Bitcoin yield. And we'll be going deeper into these different metrics as we have guests on that are really at the forefront of developing the ways that we can measure the financial performance of corporations that are adopting Bitcoin as part of their strategy. Now, when we look at the outcome for the common stock holders, MSTR over the past year, has even outperformed Bitcoin itself. And that, I think, reflects the leverage that it has. Now, of course, we're looking at returns. We could also talk about the risks. And all of those are disclosed in their SEC filings. But I just want to point out not only this outperformance of MSTR relative to Bitcoin, but also relative to the Magnificent Seven, the overall stock market of the S&P 500, and gold, of course. And so this is highlighting that corporations really need to pay attention to the price signals that the market is sending, and to educate themselves about what is happening in at the cutting edge of corporate finance and how they can be involved and to create value for their shareholders. This goes to a thesis that I've had for now more than a decade about how Bitcoin adoption, how the flywheel can accelerate over time. And that if we look at the monetary economics of currency adoption, um, one of the mechanisms is through what Paul Krugman disparagingly called a speculative attack. Now, I don't think it should be a disparaging terminology. I think that it really is a virtuous cycle that is good for civilization. It's not attacking anything. It's really about creating value for uh, not only for the individuals that hold Bitcoin, but also for all of the individuals who, in one way or another, have Bitcoin exposure. So it might be because their government holds Bitcoin as a reserve, or their stock market portfolio holds Bitcoin through all of these different equities and potential other financial instruments. So, um, if we look at this flywheel of the Bitcoin speculative attack, we can start with Bitcoin's compound annual growth rate that we highlighted, that then drives the high return on invested capital and the asset growth for Bitcoin companies that then can tap the capital markets and leverage against those assets in different forms, whether it's through the NAV of the common stock or opportunities in the convertible bond market, preferred stock, or any other future financial instruments, gives them a lower weighted average cost of capital that they can use to acquire more Bitcoin. And that Bitcoin will continue to increase in value as well because of the fundamentals that we covered today about how it empowers individuals, corporations, and governments to be able to control their own money and to have a finite scarcity. So I think this flywheel will continue. It will continue to be volatile. Volatility is part of what drives the financial performance. So it's not something to be scared of, but rather it's something to be uh, cognizant of and to be managing that risk prudently. We've seen other corporates look at MicroStrategy's approach and adopt it. So we've got a chart of Metaplanet's growth. Now this is a log chart because let's keep in mind that as the first mover, MSTR definitely has a huge advantage. But that should not discourage other corporate adopters from seeing this approach and also adopting it as their own. Bitcoin is going to continue to grow regardless of what any one corporation does or what any given individual or government does. And so it's important to not assume that because Saylor was the first mover, that there's not an opportunity here for every corporation, for every balance sheet in the world to be thinking creatively and um, to to really create value for their shareholders rather than sticking to uh, approaches that, frankly, are underperforming Bitcoin and have been for the past decade. We also have Similar Scientific on here on this chart, and the blockchain group in Europe that's adopting this. And so, Metaplanet's actually it's interesting. It's based in Japan. The blockchain group is based in Europe, in France, and so every geographic um, jurisdiction has different opportunity sets for Bitcoin treasury companies, different investor appetites for different financial instruments. And so we're going to see not only um, people adopting or corporations adopting Saylor's approach, but also adapting it and differentiating it to their local markets and to different investor appetites. Most recently, we've seen a slew of new entities that are taking on the Bitcoin corporate adoption. So we've got 21 with the CEO Jack Mallers, who has raised capital from SoftBank, Tether, and partnered with Cantor to do a SPAC transaction. So 21 is very much focused on continuing to drive Bitcoin adoption and to tap the capital markets to create value for their shareholders and to increase the Bitcoin per share for them. Furthermore, we saw Strive Asset Management, a company backed by Vivek Ramaswamy, and they are doing a reverse merger with asset entities to build that Bitcoin war chest, a fortress balance sheet with Bitcoin as a long term investment, and to identify ways that they can not only um, acquire other companies that might have so much cash on their balance sheet that it actually exceeds the value of the stock. But they're also looking at ways to introduce tax advantaged ways to acquire Bitcoin on their balance sheet. And most recently this week, David Bailey, the CEO of Bitcoin Inc., which is full disclosure, this is Bitcoin for corporations, is a part of David's media empire through Bitcoin Magazine, and so this new entity, uh, Nakamoto, is doing a reverse merger with Kindly MD to launch a new Bitcoin treasury company that is going to tap into the global adoption as a MicroStrategy squared, as Mr. Bailey put it, that is going to be investing in the Bitcoin treasury companies all over the world and bringing that exposure to the capital markets. All right. So I hope that you found this introduction to Bitcoin corporate finance interesting and educational, and that you are able to now understand what is going on, why this trend is not just a flash in the pan, why it's going to continue to grow. I hope to see you all at the Bitcoin conference in Las Vegas. There's still tickets available, so you can still join us there. We're going to have there's going to be lots of announcements there that'll be breaking news, and we're going to have lots of leaders in corporate finance join us on this podcast to dig deeper into all the different concepts that we got a broad overview of today. And we really want you to share this with your network and with others in the world of corporate finance who are interested in Bitcoin, who want to understand what are the fundamentals driving it, what is this new Bitcoin capital markets that is emerging, what are the opportunities, what are the challenges as well, of course. And if there's anyone that you want us to interview, feel free to suggest names. We look forward to engaging with the audience. So give us a follow and leave us a review. And thank you for joining us today.